Hey folks, this is your host Mandeep, and in this tutorial, we're going to take a look at moving average convergent divergence. Now, most of you are familiar with the MACD indicator and use it on ongoing basis within your trading strategy. But what I'm going to show you today is a slightly more a sophisticated way of approaching um, the use of MACD. Now, I just want to mention early on in the session that there's a standard indicator that comes with Thinkorswim that you can use for MACD, and I also have a pair indicator that is definitely more sophisticated because it offers the usage of MACD on multiple time frames. And when you use it on multiple time frames, it gives you a confirmation on higher time frames and thereby giving you a higher probability of trade. Now, this is the standard indicator that you can install from your Thinkorswim platform, right? So this cyan line is basically your MACD indicator, and then the yellow line is a 9-period moving average, right? And then you have a zero line as well. And the standard way most people use the MACD is when the MACD indicator crosses above its 9-period moving average, right? So when it is above, it's positive, and when it's below, it's negative. Now, what I'm going to show you is there's a slightly better approach, a better way of using it, something that gives you a little bit more granularity, and that should give you, much better trades after you start using it. But before we get into that, let's take a look at the moving average convergent divergence and what are the basic definitions of it. And just by understanding this, you can sometimes change some of the parameters that come along with it to suit your trading style a little bit better. So moving average convergent divergence, or MACD for short, is nothing but a difference of the 12 period exponential average of the close. So, and you subtract that from the 26 period exponential moving average of the close, right? That's really the definition of MACD. Now, in order to make your trades a little bit better, what you do is you want the MACD to be trading above its 9-period moving average. So what you do is you calculate, just for illustration purpose, I've called it average underscore 9, which is nothing but the moving average of the MACD of the 9 period, right? So that's basically the two parameters in this definition. Now, what we're going to take a look at is how is it normally used. The way MACD is normally used is the second definition, which is the secondary, is what I call secondary, where the MACD is greater than the average, or the MACD is below the average, and that's how most people approach how to use this, right? So it is bullish when MACD is greater than its 9-period moving average, and bearish when it is below the 9-period moving average. I also add, two other, small methods, and one of them is the first one is the primary, where the MACD is just, is going to be positive when it is above the zero line, and it is negative when it's below the zero line. As simple as that. But we're going to look at it on multiple time frames, just not on a single time frame. And finally, we can make it even more, sophisticated by, putting in a rule where not only MACD has to be greater than the 9-period moving average, but the MACD also has to be greater than zero. And for the reverse situation, which is the bearish scenario, we have MACD to be less than the moving average, and MACD is less than zero. So let me walk you through the significance of the colors, and I'll show you what I mean by that. Now, this is only relevant when we are in the primary mode or the secondary mode. So what we are saying here is that when MACD is greater than its average and it's trading above the zero line, that's your green and the most bullish situation. However, your MACD can be above the zero line, but when it drops below its moving average, it's now yellow, which basically, is a sign of caution, right? It could revert back to being green, or it could continue its downward trend. That we wouldn't know, right? That we can only see on the chart as we're going through the trades. Then we have a situation when MACD is trading above its 9-period moving average, but it's below the zero line, right, which is going to be depicted in the color cyan. And finally, when MACD is below the zero line and it is below its moving average. So that's your absolutely bearish situation. Now, when you're moving from red to cyan, it means if you are in a short position, then it could be a reasonable spot to close your short position when you go from red to cyan. And likewise, when you're in a long position, as you go from green to yellow, it could be a reasonable spot to close your trade. Now, all of these are obviously more applicable to people who are trading on short-term basis, right? Now we'll go back and take a look at the MACD indicator again. So this is the situation. There were three situations I called out. So first of all, you can have MACD to be above its zero line. Sorry, the MACD above the average but below the zero line. And so what we're going to do is the indicator that I have, which is the paid version, gives you a lot more granularity, right? So we'll take a look at a situation, let's just look at the primary scenario first, right? So in the primary scenario, what happens is that so you have four time frames that we use, right? So if you're on the 15-minute chart, this first line is the 15, this is the 30, this is the hour and the day. And again, you can use it on any time frame of choice. You can use it on the 5-minute. If you use the 5-minute, then the next additional time frames are 10, 15, and 30. If you're trading the hourly, then you get hourly, 4-hour, day, and a week. Or if you're on the day chart, you get day, 2-day, 3-day, week. So you're always getting confirmation from three additional higher time frames. And when those three additional higher time frames are in your favor, then the probability of a trade working out is much higher. So let's go through the colors first, right? So anyway, so I said, now you use the cyan color happens when MACD is trading below the zero line, but it's above its moving average. So that's when you get the cyan color. It's green when it is above the zero line and it's trading above its average, and it's yellow, right? This is yellow, and when it's above the zero line, but the MACD has dropped below its moving average now. So when you're in the primary trend, right, all you care about is the fact that the MACD is trading above the zero line. You don't care whether it's dropped below its average or not. Now, even though I show this color in yellow, but essentially you see a top bar drawn, which is essentially showing that everything is trading above the zero line, right? Even as I again mentioned, this is yellow because it's dropped below, but that's not what we care about in the primary trend. All we care is it is trading above or below the zero line. So just by looking at it, it is telling you that on all four time frames, your MACD is trading above the zero line, right? So that's one, approach. Now, you can get a little bit, you can tighten the situation a little bit by, going into the studies, and instead of primary, you click, secondary, and all you do is just, select the secondary option here. This is their fast length, this is your slow length, and this is the moving average. That's what we use, but that's also configurable using the approach that I have. Now, when we go into the secondary mode, and apply this, we'll see that this spot was yellow, but you did not have a top bar, which is the sum of all four bars to be true. Now in this situation, when it all got green here, the thing you'll notice is that uh, the primary trend, the secondary trend is correct. In other words, your MACD is trading above the 9-period moving exponential average. And when it is green across the board, it's also telling you that it is above the zero line as well, right? So this is above the zero line. In this case, when it turns red here, it has dropped below the zero line as well as above below its moving average, and that's why nothing is aligned uh, on the top bar. The top bar only gets aligned when all four of these time frames have your MACD trading above its moving average. Now, let's look at the last scenario where you need to have both the situations to be true, right? And in this case, you will not see any, you will only see two colors, which is red and green. So let's apply this and hit the OK button. And so this is your scenario where uh, all of them, all four time frames, your MACD has to be above the zero line, and the MACD has to be above its moving average as well, right? So let's take a look at Apple in this scenario. So when all of these got aligned, there's an opportunity of entering sort of a long position here, and everything is aligned and it's working. Now at this stage, your shortest time frame, which is always uh, you know uh, the the chart, the time frame that you happen to be in this case the 15-minute chart, and this is actually representing the 15 as well, right? But these are 30 hour and a day. So all you know is at this stage that the MACD has dropped below its exponential moving average on the shortest time frame, which is the 15-minute time frame, right? Now, um, since the other time frames are in your favor, you can actually stay in the trade, right? So I have a close. I'm also using another indicator, which is the ultimate trading signal, which is not the focus of the discussion today. But in this particular setup that I have, no matter what, I close the trade at the end of the day. But if I were, not to follow this technique where I'm not closing the trade at the end of the day, then this long will actually still be intact, right? So, but in case you're actually day trading, you can say, all right, so I got a decent run starting here, which is about 235, and to about 240. That's $5, right? In 2 days, and you can say I'm going to take my trade off here because the trend is actually shifted on the shortest time frame that I was trading in. So I was trading the 15-minute, the trend has changed. But that trend may not have changed on the 30-minute, right? So if you go on the 30-minute, we can take a look and see whether all four time frames are still aligned or not. Now, as you can see on the, if you were trading the 30-minute, all of these are still aligned, right? So if you were trading the 30-minute, you can still stay in the trade, but this could, potentially, come down tomorrow, but we don't know for sure. All right, we can take a couple other examples and we'll, just look at the 15-minute chart. So here's another example where everything got aligned around at this point, right? And so you enter the trade, and clearly you got shaken out, right? But it depends on your approach here. Now, as you can see, the hourly time frame and the day time frame are completely in your favor. So this is nothing but um, you know um, a small retracement that's happening while the bigger picture continues to be intact. So just by looking at this signal, you can stay in the trade, much longer as opposed to, getting shaken out very quickly. Now, this is a good example of a trade that I actually ended up taking today. And when I took the trade, I realized that yes, at the shorter time frame, the MACD started to fall or drop below its moving average, but the higher time frames were still in my favor. So instead of taking the trade off, I actually stayed with it, right? So while it went through this little retracement, I wasn't too worried at this point in time because the hourly time frame and the day time frame, I could see just by looking at this, not only is the MACD above its moving average, it's also above its zero line, right? So I stayed in the trade, and eventually, at worst case, from where I bought it to, where the trade ended, I was at least even to just slightly positive by maybe about $100 or so. So we can, just like, flip through a couple other examples and see how it works out on some other trades or some other charts as well. Now in this case, as you can see, the three time frames are in your favor, but the fourth time frame is actually neutral, so it hasn't given you a signal. So it'll depend on how you want to approach your trade. So if you just think that three alignments are sufficient, you could actually be entering the trade here, right? So if you entered the trade here, it's a 165-ish, and then by the time it closed, it was 167. So about $2 sort of in profit if you took this approach. So this is why this is more sophisticated way of approaching and using the moving average convergent divergence than your standard way, because in this case, depending on your style of trading, if you are extremely aggressive, you can be you can use the primary mode where you just want four time frames to be aligned, where MACD has to be above the zero. You don't care whether it's above the average or below the average. Now, if you're a little bit more conservative, you can use the secondary mode where you're saying the MACD has to be above its average, but you don't care whether it's above the zero line or below the zero line. And finally, when you're using both, um, MACD has to be above zero and above its moving average for it to be green. Otherwise, not you will not get a signal. So hopefully this gives you a slightly different approach of using a MACD, and obviously these parameters can be adjusted as well. I've lately been experimenting with just 5, 15, and 2, just so that I've found that to be a little bit more responsive for my style of trading, which is mostly day trading. And I can do another tutorial on that with some additional examples uh, another time. Have a wonderful day. Bye bye.